All right, let me breathe for a second here. I feel like I've just been running. I made it with 1 minute to spare, so hopefully everything goes well. Apologies for the last minute stuff. As I mentioned, I went over to Calgary to see my mom, and didn't work out so well. COVID restrictions and terrible internet. There was a lot of issues over there, so had to race back to Vancouver, grab an Airbnb, set up everything. I haven't even unpacked my car yet, so yeah, here we are. Makeshift studio, best I could do on short notice. So I have to double check, make sure everything's okay. I literally just turned it all on and hit go live. The software's not even showing me the comments yet. Hopefully I'm live. I'm going to have to assume that I am. All right, there's a first comment, so I will assume we've got a few people watching. Wow. Okay. So the first issue, just let me check my microphone is even on. Scarlett. So I was racing to get everything set up here, and I mentioned a few weeks ago that I got a new soundboard, a really giant soundboard that actually sounded pretty good, but it's going to be tough to travel with. But as I was setting it up, the plugs are everywhere. It's a new house. I have no idea what I'm doing. And I just frantically ran past it and kicked it, and the cord ripped out of the machine completely. So that was broken about 7 minutes ago. So I had to frantically set up my old audio mixer that obviously it's not as good. It's the reason I bought a new one. But I was very fortunate that it was literally next to the computer at the time. It was in the same bag as some things. So we got lucky on that. Hopefully it sounds okay. The picture quality, terrible, all blasted out in the background. I'll fix it all. Fortunately, this is just a casual VTS community thing. So markets are crashing, or at least looking like they might crash. I really did figure there would be a few questions today. So very good time to do a stream. Very bad time for me personally. But so far anyway, I think we got it done. So I can relax. All right. So basically, these are just for people to ask questions. The public live streams that I send out ahead of time, I usually prepare something in advance. This one is just comment section there. Hit me with all your questions. We'll try to stick around for about an hour. If there aren't any questions, then I guess there aren't any questions. But what can we say? So first of all, let's just see where we are at with the market. So the S&P 500 is down 1.15%. The VXX is up 7%. I usually just go through a quick little checklist. I don't actually check that many things in the morning. I know a lot of more active traders, they have massive watch lists and whatnot. My work is typically all done through spreadsheets, and it's all prepared. I input all my data in the morning, and then it just basically spits out the trade signals for the day. So for me, I don't actually have to open up trading softwares that often. And I'm certainly not the type of person that sits in front of my computer all day long. I'm probably in front of the actual trading platform, maybe an hour a day maximum, and probably do trades for literally 5 minutes or less, as you've seen with VTS. But I still like to check things out. So see the VIX futures. I know that potentially, if things get worse, what we could see is the VIX futures go inverted. Right now, we only have the front month future dip below the cash VIX. So this is pretty normal. Like I mentioned on Twitter, I don't know if you follow me on Twitter, but I just mentioned it briefly. One of the first stages of a potential sell-off typically will be something like this. You'll see the VIX index spike, and you'll see the front month VIX future below the VIX index. But these front two futures, M1 and M2 as we call them, those ones, it takes a little bit more to get those to invert. So as a really initial warning shot, as I mentioned on Twitter, just a shot across the bow, you might see this situation where the VIX index is cutting through the first two. If we get to a situation where this front month is actually above the second month, like if this goes up to 24 and this one's still hanging at 23, then that would be an inverted contango situation. It goes into backwardation. And that would mean that there's probably a little bit more to worry about. Right now, we're just in warning signs. So, as we saw, we are going to move completely to safety today, but it's not one of those moves where you really feel like it's, red alert, run for the hills. It's just an initial warning of some potential things developing. We've had, 2 months of relative calm. If you want to include going back that, subtract February 25th, subtract January 27th, just a couple of days, just hit hard and then went back to normal. Probably we've had 5 or 6 months of relative stability minus a couple of really bad days. So it would not surprise me at all if the markets wanted to take a little bit of a breather. I think it's healthy to see a 7%, 10% correction in the market. Totally fine, nothing to worry about. And for us though, I don't like to ride things down at all. We manage drawdowns. So we're going to move to safety. The good thing is, moving to safety, a lot of times people don't really like to because they feel like, well, what happens if tomorrow the market just corrects and by Friday we're at all-time highs again? That could totally happen. Of course that could happen. But the good thing is, the way the volatility barometer got there this time, pretty quickly, it does mean that the volatility metrics themselves aren't overly elevated, which means that we are getting kicked into safety, but it wouldn't take very much to get us back into those aggressive positions. There's not one of those situations where the market is going to bounce after a 2-month long sell-off. Sometimes volatility can be a little sticky in those situations. It can take us a week or two to get the confirmation that it's all clear. In a situation like this, because it developed quite quickly, we can also get back into the market quite quickly as well. So we're just going to sidestep anything for a day or two here. And then, of course, I don't know what the future holds. We'll see what the metrics say. But not that big a deal to just move to safety and try to avoid whatever's coming. Obviously, as I always say, it's certainly possible that, say, the markets are at an all-time high, some type of cyber attack or a terrible situation happens and the market crashes 10% in a day. That can happen. But typically, for the most part, in order to see a 20% correction, you first have to see a 2 or 3% drawdown. 5%, 7%, it progressively worse is the typical situation. So exiting on the first sign of trouble is essentially what has gotten us our very, very consistent rate of return over time. I don't know if I have something to show there as well before I open it up to the questions. I'm just waiting for people to fill up the comment section. So, but the reason that the consistency happens like this is for that reason, because I don't wait around and see, okay, I'll see if it's a 10% or 15, maybe exit then. I don't do that. I just, first sign of trouble, move to the neutral safety positions and see what the market wants to do. If it wants to recover, great. We're going to jump back in on Thursday or Friday and we're going to be in equities again. If it doesn't, and this is just the beginning of a extended sell-off, then we're going to be very happy that we exited to safety. So either way, this is the way VTS works. We basically trend follow volatility along the way, and I am overly sensitive to drawdown reduction. That, in my opinion, is by far the best way to get a long-term rate of return. If you want to make 20% a year, don't focus on making big profit. You want to make 20%, focus on reducing the drawdowns. And over time, as we know, there are plenty of bull market periods where you'll make tons of money. Even by accident, beginner traders can do that. If you want to make 20% a year, you really do have to reduce those drawdowns. So that's how I've achieved it in 9 years. That's how I would suggest, recommend that other people attack their trading as well. It really is all about drawdown reduction. 70, 80% of the time, the markets are going to be cooperating with everybody and every strategy. No matter what you do, you're going to be making money 70 to 80% of the time. It's how you manage that other 20 that really separates the good traders from the ones that are just on the hamster wheel of up, down, and they never really make any progress. So, Yep, we're going to move into all safety. All right, there's a few questions. Let's jump into those. Again, for everybody just showing up now, this looks very strange. It looks bad. I don't know how it sounds yet. There were issues. So you can watch the beginning of the stream and I'll explain why it looks so weird today. But let's go to this first question. Have you tried to backtest short stock instead of bonds gold during rough times like today? Yes, I have. Sometimes it's hard to find things on the fly, so give me 1 second. Short answer, doesn't work at all, but let me try to find an article for you that might demonstrate that. So what would I have called it? Short S&P maybe? Okay, so this is good enough. It'll give a general impression of answering your question. There are major problems with shorting. So what this isn't instead of bonds, but this is instead of gold. So what happens if when we get those gold positions, which is essentially, it's not exactly, but you can consider it, say, above 75% or so on the volatility barometer. What would happen if you shorted the S&P instead of buying gold? Well, that's the tactical balance strategy. This is the result. So SH is a short 1 times S&P 500 ETF. And these are the results. So this is the gold, just the gold portion of my strategy. You can see that gold, of course, can be a little volatile, but it's going in the right direction, right? It's definitely a profitable trade. Every time that I've ever held gold, it is profitable for the most part. Short stocks is a complete disaster. And this is a backtest, what actually would have happened if I just simply switched SH, inverse S&P, with gold. Now, you can read this article. What did I call it? Article 588 on the website, short S&P instead of gold. And just a reminder, there is a search function for everybody watching this. You can, type something in the search and see what comes up. Looks like I did a couple of articles on this. You can read this one. And what are the reasons for that? So why is short stocks so terrible during safety positions? Let me just go on the fly here because that's an old article. So what's essentially happening is, for example, right now, we're getting a warning sign. We're going to move into a safety position. What were to happen today if you actually directly shorted the stock market? Like I was just saying when I was rambling before, 70 to 80% of the time, the stock market's going to be going up. And so if you're in the habit of every time you see trouble, you short the market, most of the time, nothing's going to materialize. I mean, odds are that in the next day or two, the market normalizes and continues going upwards. There's always that chance that you're going to catch it just right and you're going to short stocks and make a bunch of money. But most of the time, shorting the stock market is very short-lived profit followed by losses. So that's what's happening. You're essentially moving into a position that for the majority of the time is going to move against you. And so there are times, like you saw in that chart very briefly, you can have periods where you think, wow, it worked out great. This is the financial crisis. This is the European debt crisis, 2015 China scare. You got Volpocalypse over here. You've got COVID over here. There are times when you can time it right and you can make a little bit of money. But the markets will bounce. The markets will recover, and you're going to be holding short stocks when that happens. So it's just a general constant bleeding portfolio position that you really don't want any part of. This is one of the things that separates my work from a lot of the others out there that you might think there's some similarities, but there really aren't. There are a lot of people who try to do that. There are a lot of people who try to either short the stocks or try to hold a constant long vol position. I don't know why they do this. Their results show that it doesn't work at all. There's a lot of those funds that do that make a 0% long-term return. That kind of trading just simply doesn't work. It sounds good in theory, and I understand the question. Great question. But no, in practice, shorting the stock market is nearly always a terrible idea. Even if the markets are crashing, it is still a terrible idea because at some point they're going to bounce, and at some point you're going to be in the wrong position. If you get lucky and you get 3 good weeks, well, it's going to be followed by a pretty strong market bounce, and you're going to give all that back. So it's one of those things that in theory, I totally get it. In practice, terrible idea. doesn't work at all. So hopefully I answered that for you. All right. I'm in Europe and I can't directly buy IEF, TLT, or VPU. Yes, MiFID II restrictions in Europe makes it very difficult. So what would you do stock replacement even if they are illiquid? What else would you suggest? So stock replacement is totally fine to do for the Europeans, and most of them do. The other thing that you want to look into, I'm going to screen share here, even though it's not necessary. Sometimes I like to demonstrate how the website works, but if you go to the website search function, just type in MiFID and you'll get this article that I did. This is pretty old, over 2 years ago, but essentially, sorry, my voice is going. Essentially, the first choice that you want to do is you really do want to find ETF replacements. And it can be tricky. Every country is different, but there are plenty of available ETF replacements that simulate those positions. In this email or in this article, I just showed a few, but there's many, many more. Now, I am not an expert in any way in European ETFs. I don't have a list. The tickers, I don't even really have access to the exchanges to check. So what you'd probably want to do is ask some asset manager in your country, and you might have to pay for it. Maybe you go to a fee-based financial advisor and pay him for a couple hours of his time to get you some ETF replacements for all of our positions. You can replace stocks, bonds, and gold with other ETFs. That would be your first choice. The second choice is what you're talking about, stock replacement. Now, the benefit here is that you can simulate any long or short position using options. We do it in the tactical volatility strategy, which it works the exact same way. The only difference is, instead of buying long put options on VXX, you'd be buying long call options, hopefully high delta, so that you can simulate more on those underlines. There's a few things you want. Of course, you want high liquidity and you want low dollar values. So for your question, where is that question? Instead of IEF, I would use TLT and just go for a lower delta because IEF moves slower than TLT. But IEF probably isn't liquid enough. TLT definitely is. VPU might not be liquid enough for you. You might want to use XLU. Let me just double check that. XLU, yeah, just to get the ticker right, because there's so many of those. XLU is the utilities ticker as well, and it's more liquid. So you might want to look into that one. And but I would definitely suggest that you really do make an attempt to find ETF replacements because it's much easier, and they do exist. It's just, of course, those MiFID II rules make it all difficult for Europeans, but that would be the first choice, the easiest choice. Whatever country you're in might be slightly different. Maybe you can access all of the London exchanges in your country. That would be great. I would look into that. But yes, IEF. Probably no. VPU, probably no. Use TLT, use SPY, use the Qs. Make sure you're doing liquid things. Sorry. Hopefully my microphone is working. It's my old audio mixer. So I moved to safety. Which one of the indicators today appeared more relevant for the sign change? All right, well, doesn't work exactly that way. And of course, just based on, sorry to be selfish, but proprietary reasons, I can't just go out and tell people what the signals were. But let's look at the list of signals. Obviously, the volatility barometer is the most important. Everything that we do, while the strategies don't directly get information from it, as in the number itself doesn't determine the trade, that's only true in the VB threshold. VB threshold is the only strategy we have that literally uses the volatility barometer completely directly. 0 to 20, 20 to 40, that's the only strategy. The other three, tactical and the vol trend, they use a totally different set of indicators. Some of them are here, some of them aren't. They're different thresholds. We need to do this so it's a diversified portfolio. If they're all getting signals from the same place, then it's no longer diversified. But if you wanted just for me to say which ones are giving the warnings today, cash VIX oscillator. The reason that would be giving a warning is because the VIX 90 the short end 9-day VIX did substantially outpace the 30-day VIX today. So this little kink in the curve, that is a warning sign. And you would get that directly by looking at the cash VIX oscillator. The other thing would be the VXX crush level is also flagging today. The reason for that, like I said before, is while the VIX futures are technically still in contango, and comfortably so, you can see that the roll yield, which is the front two, basically the VX30, front 2 months compared to the VIX index, that has substantially collapsed right there. You can see the VIX is now slicing through the front 2 months. That indicator will show up in the VIX crush level. So I would say the top 3 always default to, the top, say, 5 of these. But you definitely do want to be watching these crossovers. You want to be watching the VX30. It's creeping quite high, 73rd percentile. And then, of course, the roll yield here, you can see it's 12%. That's very, very low percentile rank, right? We are negative roll yield. That's not going to be good for things like short volatility. It's not going to be good for long equities. So in a nutshell, those are the indicators. Those are the things that we're watching. Again, only warning signs so far. Nothing too diabolical. What's the market doing now? Sometimes I get in the habit of checking, and then, every 20 minutes you want to check the market. Nothing too crazy right now. It's just slight warnings, move to safety, reassess tomorrow. Kind of one of those situations. There are times when it just rips your face off. You just wake up in the morning and you just get crushed. So far anyway, knock wood, it's not one of those situations. But again, I take all trades at end of day, so I don't know. Maybe by the end of day, the stocks are down 5%. Maybe they're green. I mean, I have no idea. But it's definitely time to move to safety. So, bonus question. Do I ever answer to questions asked on Twitter DMs? Almost never. My Twitter DMs are, as you can imagine, I think I have something like 15,000 people following. And I'm generous with my time, and people know that. So you can imagine my DMs fill up pretty fast. I just can't manage questions in so many different areas. Email, of course, if somebody has my email address, it is public. I make it public, but I don't make it a point to say, this is my email. I mention it here and there, so the public knows my email address. But if you have my email address, chances are good that we have a better relationship than just somebody on Twitter. So I'll always answer my emails. Number 2 best spot to ask questions with about a 4 or 5 day delay would be in the YouTube videos themselves. Always make comments, ask your questions for that video. And then, a distant third would be on Twitter. There are times when I open them up, but typically it's only when I recognize the name as somebody that I'm in a conversation with. So don't bother DMing me on Twitter, honestly. Just email me. There's many times where I won't even see it. I'm assuming you're asking me because you asked me something I never answered. Apologies for that, but I'm just too busy. I can't answer them. And 95% of my DMs are silly questions anyway. They're, what do you think? What do you think of Dogecoin? Are you buying it this morning? Stuff like that. I have no time to answer those DMs. I suggest BTMA for IEF. Oh, that's interesting. I don't know. I can't confirm or deny, but you definitely want to find European equivalents. Like I said, they do exist, but I've had people call their brokers and ask their broker, and their broker won't help them. So I can't say that they won't. Maybe it's worth a shot. Call them and say, hey, are there any replacements for these? They might tell you. But again, the probably the best course of action would just be to set yourself up with a nice list of replacements. Might cost you some money up front. Pay somebody, fee only, who knows these types of things. Because of course the US markets are easier to trade. They're more profitable. So there's probably a lot of European asset managers that will know this information. Just pay them for their time. Get a couple hours, make your list, and then you'll do it once and then never again. So that's what I would suggest. One of the reasons markets are correcting now is the inflation fear. Going long on rates now wouldn't be dangerous in this higher rates trend environment. Have you tried tips instead? It's hard to even call it a correction, really. I mean, we're only, what, 2.5% off all-time highs in the S&P. So we'll see. I will say that the talks of inflation have ramped up in the last few weeks, and of course for good reason. There's definitely higher inflation than the official government numbers are showing, and it will no doubt get worse. Sorry, I just noticed that my picture is pulsing, my autofocus. I think that's because I've got two ring lights behind me, and I've got two of these blasting on my face as well. I'm sitting here, I'm like on the surface of the sun doing this live stream, and it's still pulsing. So sorry for that. The background might be moving around on you. But yeah, inflation is going higher, and it's going to keep going higher. Whether that will affect the sell-off or not, we don't really know. Equities don't really follow any rhyme or reason these days. So it'll sell off when it does. It won't when everybody thinks it should. Basically, I think the best thing to do would be to have faith in the volatility metrics, because volatility signals are consistent through every different sell-off. If you're just looking for equity-based signals, every sell-off is different. That's why, all these traders and asset managers out there who are looking at, broad equity indicators and bond indicators. The problem there is that it might work during this sell-off, but it would be completely different for a different one. Volatility metrics tend to be very consistent through different sell-offs stretched over multiple years and even multiple decades. So I don't really get into that whole trying to predict rates and, okay, I'm in TLT now and it's worked in the last 7 years, but we're going to switch that out for something that's working in 2021. I don't really do that. I just try to remain consistent with what I do, follow the volatility metrics. Our safety positions are bonds, and I've done some live streams and some articles talking about how it's still beneficial. Even though rates are at the bottom, we're still technically profitable mathematically on all of our bond safety positions. So no reason to switch yet. I'm not married to any of them, but so far I don't see any reason to switch. And I don't so much get into these types of things where you're trying to time rates and avoid that because rates might go up, and avoid stocks because inflation might, do this or that. I'm a trend follower that needs actual confirmation. I don't plan my trades based on what might happen 6 months from now. I plan my trades based on literally what it looks like in the moment today, and I can switch tomorrow. So I don't need to even consider inflation in my models. Inflation doesn't show up in one day, and so I don't need to take it into account. And rates don't change in one day, so it's just not in any of my models. We'll tackle that one when it actually happens. Okay, Hans, I know you don't like leveraged bond ETFs. Have you backtested extended duration like EDV in lieu of TLT? I have not. Let me write, wow, this is quicker. Take a screenshot of that. I'll get back to you. Maybe in a future live stream, I'll just remind people that there was this question. I'll show you a back test of substituting in for IEF and TLT, and we'll see what it looks like. My IB says that delayed data is displayed. Is that an issue for choosing limit price for options? I have to be careful how I word this. Probably no. I mean, typically no, because the way that options trading works, and it's a little scary when you do it, it doesn't actually matter. As long as you're trading liquid underlines, the computer will match up your best price at the time. So there are times when you might put in, say, $1. If that contract is actually going to go through at 95, if you put $1, you will very often get that 95. So you'll realize that the price that you entered for your option trade isn't the price that it executed. You might have got a different price for that. It won't ever be above. Like if you put a limit of $1 and you're buying something, for example, it won't execute at 105, but it can actually give you a better price. So I don't know. I only trade with TOS and IB. And in both of those situations, I've always noticed that even if there's some type of platform delay, I'm still getting the actual best prices. It's filling me in prices that are below my limit, or if you're selling options above the limit, that can definitely happen. So I tend to think no, but that's why I said if you ever have, certainly for reverse split situations, I made a strong point last week of talking about it, where if you ever have reason to believe your platform might be showing incorrect numbers, just best practices, why not? Why not start at prices that you know are way out of the ballpark and then just progressively tick down? I would say do that. For the vast majority of the time, I have no reason to believe that what I'm looking at isn't live. It sounds like you do. It sounds like it actually says it's delayed data. So number one, you might want to call IB and actually pay for the feed. This is what platforms do these days because commissions are so low. Now they're actually charging for data more than they ever did before. When I first started, you pay $2.99 and you get a data package for everything you ever trade. These days you have to click each individual box. Do I want futures data? Do I want live? All these different datas, contracts. You might have to just go back into your platform and tick some of those boxes and pay $5 or $10 a month to get these live numbers. So it is what it is. Free commissions is never free. The company itself is always going to find reasons to make money. And their profit just went from commission-based to selling data feeds and whatnot, selling to third-party information. All that stuff is, they're going to make their money. So that might be your problem there. Maybe you just haven't updated it. Okay, how do you choose which assets to use when rotating into safety? Gold and bonds sound reasonable and have negative correlating to equities, but maybe not the best. They are the best long-term, but surely if you were to test each individual sell-off, you could find different ones that perform differently and maybe better in that specific sell-off. But long-term, it's really difficult to find something that isn't better than bonds for a safety and isn't better than gold for going the other way. Extreme sell-offs where you actually might want to get a little aggressive. There's nothing better than those. On an individual crisis to crisis, it's all up in the air. For example, during the COVID crash, utilities did extremely bad. So the defensive rotation strategy, for 10 years and way more than that going backwards, utilities significantly outperformed the S&P during sell-offs. That's why that's our safety position. It technically will go down, but substantially less than stocks. But that's not always the case. And certainly in COVID, utilities got absolutely destroyed. So that can happen. What I would caution you against is making short-term decisions for long-term strategies. That's really not a good way to go about it because there's always something new that's working today after the fact. And you see it working only after it's working. So switching into these things tends to be chasing shiny objects. You're essentially seeing something, oh, I would have been better off entering that position, so maybe now I should substitute that. The next crisis, that will no longer be the case. So you're always switching into stuff that you've already seen did well in a short period of time. I prefer to take a block look long-term and say, there's clearly nothing better than bonds for neutral safety, and there's nothing better than gold for aggressive. There's nothing better than long vol for extremely aggressive. That's why we were very selective on long vol. But if the markets are all out crashing, there is nothing better than long vol. So those are the positions, and that's why they are chosen, because looking for temporary fixes and shoving things in, everybody can reference my analysis of the ARK ETF, the ARK Innovation ETF. There's a perfect example of why you should never just shove short-term performers into a portfolio, right? It had one fantastic year. For 5.5 years, it's underperforming the benchmark. It's worse than the Qs on a risk-reward basis. Tesla goes up 1,500%, makes the ARK fund look like the best thing in the world. I had a million questions. Well, shouldn't we just shove that thing into the defensive rotation instead of the Qs? Of course, right? It's doing better. Well, if we would have done that, have you seen it in the last 3 months, right? Stocks are at all-time highs. The ARK fund's getting obliterated. So that is a perfect example of why you shouldn't just look at a short-term performer and shove it into your portfolio. You actually need to know that in every market cycle, it's going to consistently do its job. And in my opinion, nothing's better than bonds, gold, and long vol. So if you have some other ideas you'd like to see me backtest for you, shoot me an email. I can easily run those numbers and we can maybe learn something. But I've pretty much tested everything that anybody could ever think of. I'm obsessive with my work. So there's probably very few things people ask me that I haven't already done and considered. But I'm not saying that to discourage people from asking. Please ask. But yeah, I've probably tested everything you can think of. So you mentioned that you miss ZIV. Yes, I do. There is ZIV-ZF, Credit Suisse Velocity Shares, Daily Inverse VIX Midterm ETN linked to S&P. Yes, there is. But it's delisted. It's essentially on the pink sheets, the over-the-counter markets. And the problem there is that's not necessarily a terrible thing if it was an equity, if something was delisted. But with volatility ETPs specifically, and several other ETPs like that, in different markets, oil, gold, all those things, they do actually require a set methodology of share creation and following an underlying methodology. So when the TVIX and the ZIV got delisted, they didn't actually delist them and then remove them from the exchanges. Because if you do that, they actually have to pay for that. If you remove, say, TVIX, for example, if Credit Suisse does that, they actually have to pay it out. But they know that it's just going to go to zero. I mean, eventually, if you just leave the thing open on a pink sheet exchange, it will eventually bleed down. But they have no more incentive to be creating shares. The authorized participants that manage these products are no longer managing them. So it can seriously decouple from its actual net asset value. You want to be very, very careful trading things once they've been delisted. Even though you can technically still trade it, it's not the same product. It's not following its methodology. And I wouldn't touch it. The day after it was delisted, even though you could keep your holdings if you wanted, you could open new ones, you can close them. There may even be liquidity. It doesn't matter. The underlying methodology of tracking the VIX futures, in this case M4 to M7 for the ZIV, it's no longer in existence. The authorized participants are incentivized and paid to keep this thing close to its intraday indicative value. And they're going to be doing that on things that are live trading, right? VXX, UVXY, all the products that are still on the main exchanges. So ZIV's dead. It's gone. So is TVIX. They still exist. You could still trade them, but I can't tell anybody what to do. I would strongly suggest people consider how the product works. And if that methodology is no longer in existence, well, all bets are off. You have no idea how it's going to perform. So yes, it's done. Unfortunately, it was my favorite product. The volume was so low. That's probably why it's still there. And there's really no incentive to close something that has that little money. I always hope that something will be replaced, but it just never caught on. So probably it's gone forever, which is very unfortunate. All right. Just answering somebody else's previous question here. Thank you for the help. Put limit orders in at a price you think you won't execute, then revise until filled. Yep, exactly. No harm in going a little bit above or below. If you're buying the options, go below, way below where you think. If you're worried about this, wait 20 seconds, bump it up 5 cents. Wait 20 seconds, bump it up 5 cents. They are computers. It happens fast. You don't have to sit there for an hour with each successive price. You can change them pretty quickly as you're moving upwards, and you'll get it. It'll click in on that mid price. They all kind of execute at the same exchanges, so it really is less important what broker you use. You're going to get the good prices anyway. If you want to be careful, you can. But I've been trading options for 15 years, and even back in the day when platforms were nowhere near as good as they are now, I still didn't have any execution troubles back then. So everything kind of works out well. You don't want to use market orders on illiquid products, of course. I've always advised against that. But you'll be fine. You'll get the prices. But remember, that is a question responding to non-live data. So fix that first. Get yourself, pay your whatever it is. IB is fairly cheap. I think it's typically about $2.99, $3.99. You can get that data feed. Have you ever considered studying a strategy including Russell 2000? Well, it's an option for me in every strategy, right? The tactical balanced, for example, this is not necessarily a MDY S&P 400 strategy. That's just the ETF that works the best in the combination of signals that I'm looking for, right? So if the Russell 2000 worked better than the MDY, I guess there's no reason why I couldn't use it. The problem is, and it could go the same thing for here. It could go in the SPY. It could go in the Qs. The problem with the Russell is that it really doesn't outperform anything else. Certainly in my tactical method of investing, it gets killed in any comparison that I make on a risk-adjusted basis. There are times when on a nominal level it can perform well, but remember, I factor in performance and drawdowns and duration of drawdowns and correlations to the broad S&P 500. And in that respect, for me, the Russell 2000 doesn't fit well into any of my models. So it's just kind of sitting there. But I can't say for sure. I mean, if you are a trader on your own, I can't say for sure that it won't work for you in some capacity. Give it a shot. We'll see. For me, on a macro level, it doesn't quite fit. I like to look at big companies, big indexes, broad indexes, more than I look for small stuff. Because I don't chase performance, I reduce drawdowns. The Russell doesn't really fit in with that very well. So, okay, can you explain why you stopped VTS Options? Yeah, I've explained this before. Many reasons. I guess, I mean, one, it didn't work out the way that I wanted it to work out. I'm going to try again. But like I said, the better way for me to do options trading, because I started my career as pure derivatives trader back in 2005, right up until Volatility ETPs launched, in 2009, 2010-ish, when I started trading them. For the first 5 years, I was purely options. No real stock trading, no bonds or anything like that, no buy and hold, pure derivatives trading. So I do have 15 years of experience in that industry. Problem is, when I was putting out my trades, I was actually trying to give a really large amount of information for every trade. So let's check out a standard VTS Options. VTS Options paid. Just a standard new trade. Where's a new trade? Here's a new trade. I tried to give out a lot of information per trade, right? We went through the reason for me doing the trade, right? There's always a little blog. There's the full details of executing it, all the margin requirements that people need to know, how to size your trade, the risk management, are we using stops or not, allocations within the portfolio. I tried to cover everything, the Greeks, the vol metrics. There was a video for every strategy. The problem was people had too many follow-up questions. That's essentially the bottom line, is that they didn't quite understand the full strategy and the reasons I was doing what I was doing. And so I would send out these emails, and then I would have several hours that day of just answering emails, just responding to people, not quite understanding, well, why are we doing this and that? So my idea was shut it down, put it on hold. The next time I do options trading, and I do want to, because that is my area of expertise, I'm going to do a course first so that people, the only way to access VTS Options in the future will be to buy the course first, which will have all the information about the strategies, basically how they work. I'm just going to give them, I'm not going to pull anything back. There's no dangling, hey, do this course and then you can do the next course and the next course. It's not for that purpose, but I do want to make sure that everybody following VTS Options knows the strategies. And so course first, then we'll do live streams, we'll do emails, we'll do all of that as well. But I just feel like it might work out better if I just give people a lot up front, and then it might include people on my methodology a little bit more. And it will allow people to take those strategies, make a few tweaks here and there that fits their investing and their portfolio and their capital size. And you'll actually have something that's yours, and you can take it for the rest of your life. So that's probably how it will work out, is that my first attempt at an options community, it was great and we had a lot of members and people liked it. It just didn't work out. There were several hundred people following it. It was not that it was unsuccessful. I could have kept going and, kept making a lot of money doing it. But for me, it's not necessarily about the money anymore. It's about having something that works for the benefit of the individual client as much or more than it benefits me. So I just didn't feel like the VTS options was giving enough. I was giving all the trades, and I felt like I explained each trade really well, just didn't explain the overarching strategy well enough. And people join in, they're new, they're not going to read 1,000 articles starting in 2010. They're just going to jump in and say, what do I do? And that was the issue, is that they just weren't up to speed. So I'll do a better job next time. My first one was a fail. Sometimes in life, in business, you try things, you have the best intentions, and it fails. Don't be afraid of failure, of course, but I'll do better next time. And when it's ready, it'll take a while. I want to put together a very good course. I want it to be one of those that just people will never have to buy another options course again. Everybody has their course. They have the gold, the silver. They have got 17 courses on their website, and you don't know which one to buy. I want to make sure that people just have a one-stop, buy this course, follow our live streams. Your options trading is done forever. You don't have to bounce around anymore. That's what I have in mind. So it's coming back. Don't worry. Give me 5-6 months. Don't nail me down to that. But yeah, it's on my mind. There's several things with VTS that I still want to tackle. Got a couple of projects and a few things to clear up with the main community for over the next several months. And then I will get back into options trading, because it should be a part of everybody's portfolio. It really should. I consider options an asset class of their own, just like volatility is an asset class of its own. And I really do believe that everybody should take the time to learn those skills, because options trading is basically synonymous with risk management. So if people don't know options trading, you've got a big hole in your portfolio. So I'll try to fill that soon. Have you ever traded options on stocks approaching earnings? Let's tie this into options trading. Obviously, you're not thinking is worth, otherwise you would not do it now, but maybe in the past, just curious. So one of my option strategies, funny you ask. Where did I put that? Just in any one of these will probably show it, I hope. This strategy number 5, called earnings plays strategy, that's essentially what it is. It's entirely targeting trading around earnings announcements. And the course will, of course, give full details and videos and spreadsheets and examples. But in a nutshell, super short version is the best way to trade earnings isn't the traditional way that 95% of the people in the options world will teach you. Most of the time, and by most, I mean the vast majority, will tell you that the best way to trade earnings is to sell premium in the build up to the earnings. And then after the earnings call, we are expecting that volatility to decline, right? And that is true. That's what tends to happen. When information is known and it becomes publicly, digested by everybody, volatility tends to drop. So that's the traditional thinking. The problem there is that you are subject to massive price fluctuations. So it's not just a Vega trade anymore. It's not just a volatility trade waiting for that vol crush. It's a very strong delta and gamma trade as well. And it's a huge problem. So what ends up happening is you get a lot of small victories when you get that, you sell the premium, you get the vol crush, you get a small victory, feels great. And then every so often you get hammered by a huge loss. And it's very similar to selling naked options on volatility ETPs, like VXX, for example. You get a whole bunch of small victories, and then every now and then you get absolutely clobbered. And you give back 17 of your small wins for one massive loss. Earnings trades are the same. That's what people are doing. But the reason that they sell this idea to people is because win rate is very high, and it's very marketable to tell people to do that, to sell premium. It's as easy as could be. You can sell that idea and it makes sense to everybody, and they can see consistent results. And then they get hammered, and by that time you've already sold your course to them and you don't really care what happens. The correct way to do earnings trades is the opposite. It is to buy the premium about 10 to 20 days in advance of the earnings call and sell that option before the earning call. The reason here is it's long volatility. So you are long Vega. What you want is volatility to increase. What do we know about earnings? They're uncertain. So what happens for the majority of the time is volatility rises as earnings is coming closer, because people don't really know what's going to happen on that call and they have to start hedging. So Vega is advantageous for earnings calls leading into it, maybe a week or so, maybe 10 days into it. The other thing is Delta and Gamma, you're now on the other side of the trade. So if there is significant price movement, you're also capitalizing on that. So you can get into a situation where there's very little downside. I mean, you can take losses. You end up getting a whole bunch of, you could take very tiny losses. If volatility just stays flat leading in, yeah, maybe you didn't get the Vega you were expecting, but you don't get hammered by that side of the trade. You want to always avoid the big crushing losses. And so that's the correct way to do earnings trades. But people don't teach that because the win rate is smaller. You get more losses, more very small losses for every win that you get. And it doesn't sell very well. Do I care about what sells well? No, I care about what makes people money. So that's why I do it. And it requires a lot of explanation, because initially people hear that and they just think it's wrong. Well, that person said it's wrong, and that service said it's wrong, and that guy says he wins 80% of the time. And yes, that's all marketing. So in a nutshell, that's how I do it. If you ask me why I don't trade earnings, I do. I target earnings quite a bit. It's one of the rare situations in the market where you can actually have a very realistic prediction of what volatility is going to do going forward. If you look at a stock market chart, S&P down 1% today. Okay, if we look at the VIX index, it's very difficult to know where volatility is going to be going forward. I mean, the VIX could be at 30, it could be at 15, it could do whatever it's going to do. Day to day, it's very uncertain. But one thing we do know is that volatility and uncertainty will increase as we approach an earnings date, or a debt crisis date that the government's going to be voting on, or a potentially pivotal Fed announcement. Those are the situations where you can actually predict volatility will rise. So you should target that, right? The best way to target that is to buy it because it's consistent. What you don't want to do is sell that high volatility and then be subject to, yes, you're going to get vol crush. Vega's awesome. You're going to collect that when the vol crush happens, but it could be dwarfed by your delta and your gamma movements. So that's a crazy, inadequate explanation of what I think was your question. But again, the course will be explaining all of that ahead of time so everybody knows what it all means. So where am I? Did anyone get IB margin increase effective tomorrow? That's interesting. So I don't know. I haven't opened up my IB yet. Remember, my long-term portfolio is with IB, so I will be able to confirm this later. What you will notice sometimes is as markets get more risky, and certainly as volatility rises, margin requirements might change at your brokers. So perhaps their models, their algorithms, are showing them some type of danger in the immediate horizon, and they might be asking for more margin for certain trades. It's nothing to really worry about. You can't control their algos, but maybe they're flagging something. I'll confirm that later. It's not a big deal. Well, I shouldn't say that. It's not a big deal for me because I trade in margin accounts and I'm never maxed out my margin. So I'm fully aware that happens. There was times back in 2008, 2009 especially, where I used to like to try as hard as I can to use every available penny of margin. And I remember back in 2008, there was it wasn't September, so it's probably August, right before Lehman collapsed and all that. I was trading VIX options, And I like to just milk every single penny out of those margin accounts. And then I got hit at one moment where my broker at the time was Thinkorswim. They increased their margin requirements just overnight on volatility related products, the VIX index, VIX options. And it was just at a time when I didn't want to close my position because I was holding a lot of short volatility that I suspected I would just collect over time, right? That's mine 2 weeks from now. But when they increase the margin requirement, you don't get to call them and say, well, hold on a second, 2 weeks from now, this trade's going to be profitable. Can I stay in it? They say, no, your margin's too low. You've got to sell it. So I had to liquidate positions that I didn't want to liquidate, and led to a loss. So since then, for the last, 13 years or so, I've always been very careful to know that one of the uncertainties that we all as traders need to be aware of is that brokers can raise margin requirements without any notice. You can just wake up in the morning and you look at your account and you're in a margin call. You don't know why. Your broker can do that on you. So be very careful. And as I've always warned, and I've done previous videos on this, but it tends to be, whether the market gods are laughing at us or not, but it tends to be at the worst possible time. It doesn't tend to happen when everything's normal, because if everything is normal, then your position is going to be fine. It tends to happen when crisis happens. That's when brokers are going to start doing it, or at least, VIX spikes. And that's, since most people, let's say 95% of the world is positive correlated to equities, that's going to be at an inconvenient time. So always be aware that this can happen at any moment. I learned that lesson the hard way 13 years ago. I probably lost $40,000 in a day because of that one. But yeah, I'll look into that. I'll see if IB did that. I don't know. Seems premature. I mean, the market's down 2.5% from all-time highs. There's, at least as of this moment, nothing's really going on in the market. It's just a couple of down days. Nothing to panic. Vol trend has today made nice premium. I'm suspecting there's more to this question. No, that's it. So since WR, maybe you forgot, or maybe it's my software. I'm sorry, I don't see a follow-up here. There's about 4 other questions and then there's no more. So vol trend, yeah, today, this is how vol trend works, right? So remember, I opened this position. I didn't wait till market close when I opened this position. In my official portfolio at Interactive Brokers, I always execute end of day, and the premium was $1.37. So that's the official trade. This trade, I remember I opened it during a live stream. I wanted to show people. So it's 91 cents. But technically, this contract went from $1.37 down to 16 cents right now. So yeah, it's pretty much crushing it. And to be honest, if tomorrow is, flat or down, don't be surprised if we just get out of this trade. We've collected so much of the premium that, it's sort of around that time when you could consider that. But that's how the vol trend works. Remember, and actually just a reminder in case people didn't focus as much as maybe they could have on last Friday's email. Make sure I'm screen sharing here. Yes, I am. I explained, okay, give me a second. Doing things on the fly. May 7th. There we go. Yeah, May 7th. I did an article sort of detailing a few of the key points of the vol trend strategy. So make sure that you go through this email. There's actually, I shared quite a bit here. I don't know if people were aware. Maybe you're in the habit of not reading my emails. Some of them are kind of meaningless. Some of them are what I feel are pretty worthwhile reading. This one is definitely worthwhile reading. But you can remember one of the points that I made is that it's a for-profit strategy, but it is technically long volatility. So it's quite a unique strategy here where it is short vol, but at the same time, there's no risk. If the volatility spikes, we get all our money very quickly. So when you see a spike like this, it's a little bit of an offset for the rest of the portfolio that's getting hurt today, of course, and yesterday. All of our other strategies are going down right now, And the vol trend is a little bit of an offset to that. It's not a huge offset. It doesn't have any convexity, as we would say. It doesn't, amplify over time, but you can get your premium pretty quickly. And you can also profit with the portfolio as well. So I love it. And trades like last Friday's are just an example of just the power of the strategy. And as well, what I should mention is just the benefit sometimes. Let's just pull up the VXX. You don't always want to do this, but if volatility has been consistently going down for quite a while, this is the VXX, we've been in a pretty extreme vol crush situation. There is benefit sometimes to getting a little more aggressive and selling a little bit higher premium. We could have gone to at the time, we could have gone to the 36 or the 35. Those were paying, 20 cents to 40 cents. That would be the typical safe play. What we did is we sold one for $1.37. So our break-even price is a little bit closer to the money, but the benefit, as we're seeing today, is if you do get a little bit of a spike, just a little bit of a sell-off, nothing major, but just a little bump there, you can actually get $1.21 in one day. It's supposed to be $1.37, goes down to 16. You can get paid a pretty nice premium up front. So that's a good example of what I was talking about as well last Friday. There are times when I sell closer to the money, and this is the reason why. You don't need to time a volatility spike. I don't need to pretend that I know what's going to happen next week and the VIX is going to spike. All you need is a flat week. If you're just predicting that, look, we've had 10 weeks in a row where the VXX is insane bleed downward. What if we just get a flat week? That's when we can sell a little bit more premium. So yeah, it's working out really well. That's going to be a nice profit. How much is that going to be? 37. So yeah, you can make about 3.7% in 1 week for that strategy. So good trade, it's going well. The other one's probably down about 2.5%, but this isn't even considered a pullback yet. This isn't certainly not a correction. It's barely a pullback. Nothing's really happened yet. So vol trend's doing well. We just occasionally, you don't mind having a flat week with a strategy like that. It's good to pull in those premiums. In your VIX trading, which option spreads do you trade? Verticals, butterflies, calendars? I'm assuming you mean my actual VIX options, which isn't something that I've shared. Let me open up the correct spreadsheet. Unfortunately, my VIX option strategy that I've been using it's my longest running official tactical strategy with systematic rules in place. I've been trading it since officially probably since 2008, and with third-party money. I used to manage money directly in that strategy since May 2011. Somebody's banging on my door, freaking me out. This is an Airbnb, so I hope somebody doesn't think that this is theirs for the week. Where's my VIX option strategy? Am I screen sharing? Sorry, I lost my train of thought. There's somebody trying to get into my house right now. Okay, where's my spreadsheet? So I'm assuming you mean my actual VIX options. This is the strategy. It started in May 2011 with third-party money. I don't ever record performance if there's nobody following the signals. That's why VTS starts in January 2012, right? I'm never going to show, stuff that's before 2012 because I didn't have any subscribers back then. So this is only for live money, but this is the strategy. It's up 51%. Don't be deceived. The first 3 months were monster. You can see those are big months, right? 39, 41, 28 in single months. I learned how to tone things way down quite quickly. I actually intend to do a video on this, show my actual live trading account from May to June and to July, just showing my best trading months ever, but and what I learned from it. But this is the strategy. So what do I do? Well, technically, I wonder if I could ever find a way to explain it. I can't really because it's so complicated. There's probably about 30 to 40 trades a month that is running through this. haven't updated this in a couple months. But the reason that it's not conducive for a subscription service and why I was managing capital directly, remember I do have another consulting company, is just there's so many trades. Typically, to answer your question though, where is it? When I'm trading VIX options, going back to about 2007, I am basically in the habit of selling premium and hedging the high side with long calls. And how I sell that center premium on the VIX is straddles mainly, strangles if I feel like it, iron condors, long calendars are also a theta positive trade. Anything like that, broken wing butterflies, but always on the long theta side of the equation, always collecting that premium, basically short vega trades. And then with the VIX, of course, it has a very unique characteristic that on the VIX index, I'm just rambling here, of course. If people are not interested, you can just listen in the background. But on the VIX index, it has a pretty unique characteristic that you don't actually have to hedge the low side very much. So if you're trading something like the S&P 500, it can go up on you and it can go down on you pretty hard and fast. But the VIX, of course, we know it does technically have a reasonable floor underneath it. So you can really spend most of your hedging money on one side of the trade. And that's very beneficial for people who know how to options trade. That's why I would recommend that everybody get some options exposure to your portfolio, because there are clever ways that we can turn this to our advantage, which you can't do with stocks. Stocks is just binary, long or short. With options trading, you can play the middle ground. So maybe I would throw out a large net right now around 15 to 27 on the VIX of a bunch of net short contracts. And then I would heavily hedge everything above the 27 level. And I don't really have to hedge the low side because it's not like the VIX is going to be at 16, next week or 12 next week. That doesn't happen. Volatility doesn't work that way. So I can actually take all of my hedging money and put it on the high side. So that's what I do. Every time I'm trading VIX only, and I'm assuming your question is VIX specific. VIX trading, meaning VIX index, not volatility trading, including vol products, because it's a totally different equation. But the VIX itself, that's what I do. I sell large premium in a net in the middle with a whole bunch of repetitive trades over time, basically every day layering trades. This is why I can't do it in a subscription. And then heavily hedge that high side. And it works out really well. As you saw, the performance it's been very consistent for me over the years. It's not 50 though. Remember those first 3 months, it's about 30, in line with the other leverage strategies that we do. Anything risky that I do, 20 to 30 is just fine with me. And that's what I do. So you might want to look into that. You ask me follow-up questions, whatever you want. All right, we've been going for an hour. And there's a large number of questions still to go. Let me take pictures. Yeah, there's some good questions. I'm never going to be able to get to these. I like to keep the streams an hour and just do more of them because I know some of you are really into the markets and you probably have nothing to do right now. You're just kind of waiting to take your trades. But there are a lot of people who can just, drop by for 45 minutes and then they have to leave. So let's do one more question and then do another one tomorrow. Hopefully it's convenient. Everybody can come back and ask their questions tomorrow. There's so many questions. That's good to see. Vol trend, can you explain? Did I miss this one? Can you explain how VXX issuer earns money on it? Is it via fees or something else? Well, it's just an ETF. So they make money for everybody holding the ETF. There's a management fee. It's essentially, you can go and you can actually see the fees. Let's go see that. It's just the indexes like the S&P 500, for example, the SPY, probably has a management fee of about 0.09. Yeah, 0.09. Very low fee. But if we go to the VXX, because it's an actively managed fund, they can actually scalp quite a bit more money. So you can see 0.89. that this is basically one of my issues with the ARC Innovation ETF. Remember, I said in my analysis, for 5.5 years, it underperformed the market. Then it had one monster year. And then in the last 6 months, it substantially underperformed the market. Well, they're taking 75 basis points when the S&P or double S&P is 0.09. So essentially that's how ETFs make money though. It's kind of built in. They just get 75% management fee, or in the VIX, the VXX was 0.89. There are some things that'll be over 1. Like, I've seen, see what the UVXY is, 1.65. I've seen way higher than that. This is how they make their money. So essentially what they want is they want a whole bunch of people trading it. That's beneficial for them. They have an ETF. It's like an asset manager. Whenever you pay an asset manager, you are paying them a management fee. Let's say 1%. ETFs are the same. They're not free. A lot of people think that you just buy the ETF and you're bypassing the whole financial industry problem. No, you're not. You're still paying the asset managers to manage those ETFs. And so you better make sure that the ETFs you're trading, because you are paying for them, that they are actually getting you what you think you're getting out of it. Otherwise, lower those fees as much as humanly possible. All right, let's get one more question, and then apologies, we should wrap it up. Okay, I thought it was the same question, but it's not. Voltrend made now a nice premium. Since we are no longer long in stocks and short in VXX options, under which circumstances would you close the Voltrend trade earlier than Friday? Well, like I mentioned, I might do that soon. Since we're on a live stream, I mean, there would be nothing wrong. Where is it at now? 18 cents. So it's kind of in the ballpark. I don't have a set number, but let's just say 0.18. Remember, it's supposed to be a $1.37 premium. There's only 13% left on this trade. So that's kind of in the ballpark of where if you're not going to open a new one right away, then yeah, I could see closing this now would make some sense. And certainly, like I mentioned earlier, if the markets are flat tomorrow or a little bit down again, probably I'll just shut it down. The only thing that I would say is it is a discretionary strategy. So I will try. There's times in my personal trading where I will take assignment if it matches up with things, but I won't do that with the public stuff, because it's just, you don't want to take that risk where you're in long shares and you don't have an offsetting trade. So we will always either be in no position or we will have a position. There's never going to be a time where I, take a assignment and we're just going to hold the VXX shares for like 3 or 4 days. That's not going to be part of the strategy. But if I am getting out of one trade and into another, and I know that ahead of time, like I did last Friday, then at that point, I will just wait till Friday, basically, because then the difference between the premiums doesn't really matter. If you get out of one at a very good price, you're getting into the other one at a bad price. If you get out of one at a bad price, like last Friday, for example, it spiked right at the close, and anybody who traded at the close felt like they got hammered. But then if you traded at the close, you got $1.37 for the next week's contract. Whereas if you traded earlier in the day, you might have only gotten 65 cents. I do intend to do a video on that, by the way. But if you're getting out and into a new one, premiums don't really matter, and I tend to wait till Friday. In a situation like this, where I'm not actually planning on getting into the next trade right now, then there are times when I just say, I've collected enough money, I'm out, and just take the 16 or 18 cents. There's only 13% left in that trade. You could squeeze it out. It's very unlikely to get back to that strike price by Friday just because of what the markets are doing now. Volatility is a little bit sticky. So it would surprise me if it was below 35 by Friday. But just wait for tomorrow. I might get out of that. If markets are up again tomorrow, then maybe not. But day to day, for you 47 people who are watching this right now, this isn't the official trade, but there would be nothing wrong with closing it out. That would be a good example of a timing of a trade where if you wanted to take your $1.20, that's perfectly fine. You could take that now. I'm not. Of course, I follow everything I say exactly in the emails. So I'm going to do what it does. And if you come by tomorrow, you'll still see that trade in my account. But yeah, you could totally do that. The problem is, where's your line, right? This is always the problem with discretionary trading, is there's no rule in place. So right now it's 13%. What if it was 16? Do you take it? What if it's 27? Do you take that? What if it's 39? Do you take a little bit? If it happens in a day, do you take it? And if it happens at 3 days, you don't? There's all these considerations, and it gets pretty messy. So I try to stay under a system, even though it's discretionary. I really try to maintain my rules and, thresholds and guidelines. But 13% is inside that range. So yeah, it could be taken now. All right, and there's at least 10 or 15 left. So, okay, well, apologies to everybody for the frantic nature of this stream. The sound, the lighting, the pulsing of the autofocus, pretty bad. But I was so frantic. I got into Vancouver yesterday, and I have not had 1 minute to sit down and rest since then. So, yeah, we'll call it a day. I think we'll do one tomorrow, but I'm not positive. So, of course, wait for the email. I'll do the same thing. There will be a link, and all the questions I didn't get to, just eyeballing it. There's some good ones there. I will get to them tomorrow. If you show up and ask them, then even better. So thanks, everybody. Have a great day. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.